People love Amazon because it makes it so simple, easy, and fast to get goods delivered to their homes. But when it comes to buying lumber, kitchen countertops, and cabinets, Amazon just doesn't cut it. Most of us are more likely to go to the Home Depot, and the world's largest home improvement retailer has recently gotten a lot of attention from financial pros. It's their third most searched home improvement stock over the last month on Trackstar, our proprietary stock search database. And as housing sales slump, consumers are pulling back on remodels and general spending. Although events like Hurricane Ian can help, a prolonged decline in the housing market would crush Home Depot's stock. Shares are down more than 33% this year, but the company pays a handsome dividend of $7.60 per share and generates cash like crazy. The firm also announced a $15 billion share repurchase authorization in August. And Home Depot has been growing its revenues year over year. From 2016 to 2021, they rose from $94.5 billion to $151 billion, with its three-year average growth rate hitting 12.2%. Home Depot is on pace for its best year yet, with its 12-month trailing revenue sat at $155 billion. It had $1.2 billion total cash and $47.9 billion total debt at the end of last quarter. And while that may look concerning, its current ratio of 1.1x indicates it's liquid enough to handle its short-term liabilities. Now, Home Depot's PE gap ratio sits at 16.9x, lower than its peers with the exception of Lowe's, and its price to sales ratio isn't that competitive either, but it does boast a gross profit margin of 33.5%, on par with Lowe's, but notably higher than Walmart at 24.6% and Target at 26.2%, both of which run more diversified businesses. Plus, Home Depot is the only company with a double-digit net income margin. It also has $13.8 billion in cash from operations and an impressive 32.4% return on total capital. And the company has an EBITDA margin of 17.36%, which is significantly higher than its competitors. In 2020, when people were stuck at home with more time to work on their houses, Home Depot saw a massive spike in revenue growth, and the firm has been able to keep momentum going. Its 7.5% revenue growth year over year is significantly better than Lowe's at 0.82% and Walmart at 3.8%. Home Depot's year-over-year EBITDA growth of 8.4% is notably better than Lowe's 1.1%, Target's minus 24.2%, and Walmart's minus 14.4%. In our opinion, this is a 6 out of 10 ranking stock. Shares are down 33% year to date, and while the housing market and economy may weaken from here, Home Depot is a leader in its space. In other words, investors should buy its stock on dips, but cautiously. We think buying anywhere between $250 to $265 should pay off over the next few years.